it's just a fraction of, it's like 20, 30 basis points of the entire, pool. And people are waking up to the fact that this is going to grow as a separate asset class. And I should allocate some to it now, because when it goes from if it goes less than a quarter, like a quarter of a percent to a half or 1% of those total investable assets, I mean, it's going to go from 100,000 to 400,000 to $1 million as it grows and becomes 2-3% of that total universe. Well, the ETFs are huge. IBET was launched by BlackRock and it gained $50 billion of assets in less than a year. It's just such a blowout ETF launch. It record set, by far, nothing even close. And so
James Lavish compares the present market value of Bitcoin to the astonishing $900 trillion universe of investable assets to highlight the cryptocurrency's extraordinary growth potential. Bitcoin is worth roughly $2 trillion, which is a very small portion of all financial assets worldwide. By contrast, gold has a market value of $18 trillion. According to Lavish, even a little change in institutional portfolio allocations from less than 0.2% to just 1% or 2% could cause the value of Bitcoin to grow to previously unthinkable levels, maybe hitting $400,000 or even $1 million per coin. Smart investors have taken advantage of this realization to lock down their Bitcoin holdings before the wave of wider adoption arrives. For more information about cryptocurrencies and the digital asset world, remember to like this video, subscribe to the channel, and enable post notifications if you like this kind of content. Additionally, please feel free to leave a comment below with your thoughts. Thank you for watching and enjoy the video.
How do you see these institutional type investors, kind of allocating and thinking about Bitcoin when it starts to get to, it's got a higher Sharpe ratio than gold, bonds, and equities. It has a lot of properties that when you put it into your portfolio, it actually makes the portfolio better.
Right. Well, and we've had these conversations. And to start, just look, the institutions are not there yet. A widespread understanding of crypto and Bitcoin, how Bitcoin is different. They're just not there yet. They're learning and they're being forced to learn. This administration talking about having a Bitcoin reserve, that's forcing some people to get up to speed pretty quickly. Because wait, if the United States is really even if it's Trump and he's bombastic, if they're really considering this is a big deal. I better get my head around it. Okay, so they're starting to wade in, and we're seeing it at the Bitcoin Opportunity Fund. We're starting to see a lot more interest from family offices, high net worth investors who have IRAs they want to put into the fund, So why are we seeing that? Because of exactly what you just said. People are waking up to the fact that, okay, if I add Bitcoin to my portfolio, and there's, you can do this. You can do the math out. There's a website called Nakamoto Portfolio that you can actually put in there different parameters and different allocations to different things. And if you put in there the 60-40 portfolio that you're talking about, let's back up. If you put in the traditional 60-40 portfolio, that you have your 6% equities, 40% bonds, and then you layer in Bitcoin on top of that. So you look at that, just adding 1%, 5%, 10%. It's exactly what you just said, is that over the last 10 years, the rate of return, the IRR just skyrockets as you go from 1% to 10%. It really enhances your return, your overall return. That's number one. Your volatility doesn't really jump that much. Your drawdowns don't jump that much on your overall portfolio. So what it's telling you is that, and exactly what you said, is the Sharpe ratio goes up. And if you add 10% of Bitcoin to that 60-40 portfolio over the last 10 years, your Sharpe ratio jumps over that special, that key 1.0, which is kind of mind-blowing to people. And then when they start to see that and they start to realize that the Sharpe ratio is the risk-adjusted return. That means that your risk-adjusted return is higher if you add Bitcoin to your portfolio. And institutions are starting to key in on that and think, maybe there's something to this thing. I really need to think hard about exactly what you just said, which is taking some of my allocation, not just from equities and putting it into Bitcoin, but from bonds and putting it into Bitcoin. And so when you look at that whole universe of investable assets, there's $900 trillion of investable assets when you add, real estate and bonds and, gold and just the cash money, and you put all that together, it's $900 trillion. Well, Bitcoin at this point is just a sliver of it. It's $2 trillion. Gold is at 18 trillion. So it's just a fraction of, it's like 20, 30 basis points of the entire, pool. And people are waking up to the fact that this is going to grow as a separate asset class. and I should allocate some to it now, because when it goes from if it goes less than a quarter, like a 0.25% to a half or 1% of those total investable assets, I mean, it's going to go from 100,000 to 400,000 to $1 million as it grows and becomes 2-3% of that total universe.
James Lavish explores the increasing likelihood that sovereign states may include Bitcoin in their reserves. He cites current debates among powerful groups such as the Trump administration and lawmakers like Senator Cynthia Lummis. Even if there is little probability that the United States will use Bitcoin as a reserve asset anytime soon, Lavish stresses that the fact that these discussions are taking place is significant. These conversations are not merely hypothetical. Rather, they reflect a change in the way central banks and governments are starting to perceive Bitcoin's place in the international financial system. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
That's been a big driver. And then you've got the Trump administration coming in. They're clearly very pro-crypto. This last administration was terrible. They were antagonistic at absolute best. They didn't give us clear regulatory clarity. Like it was just, choke point 2.0, all of that stuff. So, but that's gone. And now you've got Senator Lummis and Trump himself talking about a Bitcoin reserve. So that's huge tailwind. Even if it doesn't happen this year, they're talking about it. It's in the conversation. They're trying to create legislation around it. They're figuring it out. And if that happens, I mean, I don't even want to put a price prediction on Bitcoin.
Do you think it will happen?
I think it's a low probability this year because there's just so many regulatory hurdles they've got to get. There are so many legislative hurdles they've got to get through. There are things that Trump may be able to do on executive order, but it's a little bit different. But I do think they're going to work toward it. I think that the chances are rising with every single day. And so, interestingly enough, if you asked me this question 3 months ago, right when Trump was elected, I would say, or 2 months ago when Trump was elected, I was like, I'm not really sure. Pretty low probability. But now, they talk about it just about every day. And so this is real. They're pushing for it. And so do I think it's a probability? Not quite more than 50% now, but it's getting closer to that coin toss
argument. What are the other tailwinds that you think are driving some of the institutional interest in Bitcoin?
Well, the ETFs are huge. iBit was launched by BlackRock and it gained $50 billion of assets in less than a year. It's just such a blowout ETF launch. It record set, by far, nothing even close. And so why is that? There are institutions or hedge funds and small family offices and smaller endowments that were looking to buy some Bitcoin, but they just couldn't. There was just no way to do it. Why is that? Operationally, there's so many hurdles. Like the hurdles of trying to figure out, you've got this key issue, like who's going to hold the keys and what's the hierarchy there? And like, how do we make sure that if you have the keys and I have the key, and like, how are we going to there's no way a general counsel would sign off on that. Like, the risk, the personal risk and fiduciary risk was too high. So that's just who's going to hold the keys, where are you going to, if you're not going to custody it yourself, who's going to custody it? Are you going to leave it at Coinbase? Or are you going to put where is it going to be? And then you've got things like, where are you going to trade it? Am I going to trade on Coinbase and Kraken? What is this Kraken thing? Imagine going into your chief investment officer and saying, I got an account over here at Kraken. We're ready to buy some Bitcoin. They'd be like, you're out of your mind, right? So, I mean, these are old school traditional investors. So that's another issue. And then you've got your mark to market issue. Do you market at midnight? Do you market in London time? Do you market at New York Stock Exchange time? Where's this thing going to get marked? All of those issues, all of those hurdles were completely solved. And just completely solved with the issue of the creation of the ETF. Now you have an ETF that has to hold Bitcoin in it. So that it's a spot-based ETF. You buy and sell it just like any other stock in your portfolio. You know exactly what the leverage or the margin will be on it. And you settle it you trade it with your same trader. You settle it with your same prime broker. You custody it with your same custodian. It's made it so easy. So that's been a huge driver. Then on the backside of that, we just had the ETFs, the options open up on them, which allows for those institutions to use those options to manage their risk around their holdings, which is an important aspect of owning some sort of a security. Then you had the gap accounting. So with gap accounting, in late 2022, they changed the rule. It used to be that if you're a company, you bought Bitcoin, you put it on your balance sheet. Well, if Bitcoin went down, you had to mark it at that lowest value it went to and hold it as an impaired asset. You couldn't hold, so you're either holding at cost. If it went up, you had to hold it at cost. If it went down, you had to mark it down to that impaired value. And then if it went up again, you had to hold it at that impaired value. If you wanted to get that value back up, you had to literally sell it in the market. Well, so they repealed that. And now the accounting for it is straight mark to market. And so now companies can buy it and not be afraid that it becomes impaired. They can actually hold it at fair value. That's been a big driver. Yeah, that's another tailwind. It's a great one that the banks can now custody it. Instead of having to hold it as a liability, now they can hold it as an asset. And like you said, they can lend against it. They can do things with it. They can use it in the financial system, and it makes it mainstream. It just creates more of that mainstream adoption where, right now, like you said, if you go to, Chase or whatever, you can't do anything with your you've got to either custody it yourself or you custody it at another place that is, that it only does this kind of business, like a Coinbase or, like a Swan or a River or something like that, where they're custodying it for you. So that's going to be a huge thing. It's just, again, it creates more mainstream adoption. It allows for that, and it allows the banks to actually start really working around it and promoting it to allow their customers to buy it, hold it, and they'll get the benefit of it too. So that's a really big deal. The reserve, the Bitcoin reserve, like if you're an intelligent sovereign, you're not going to go and just announce you're doing this. You're going to be in the background doing, buying some in the background first.
James Lavish highlights how Bitcoin ETFs have revolutionized institutional acceptance. He argues that prior to ETFs, holding Bitcoin was practically unfeasible for organizations such as hedge funds, family offices, and endowments due to operational issues. Significant obstacles were brought about by problems with key management, custody solutions, trading platforms, and regulatory issues. Everything changed when Bitcoin spot ETFs were introduced. By simplifying the entire process, these ETFs enable organizations to use their current systems, prime brokers, and custodians to buy and sell Bitcoin just like they would any other stock. Adoption has been greatly influenced by this simplicity of use, as well as the potential for risk management through options trading. Lavish also emphasizes how modifications to accounting rules, such as the switch to mark-to-market accounting, have significantly decreased business risks. Lavish also highlights how banks' roles are changing, allowing them to now hold Bitcoin as an asset rather than a liability, which makes it possible for traditional financial institutions to encourage Bitcoin investments. This change further normalizes the usage of Bitcoin by enabling banks to lend against it, incorporate it into the financial system, and offer their customers greater services. Lavish wraps up by discussing how sovereign countries might add Bitcoin to their reserves. He points out that while the process might differ based on legal and regulatory frameworks, smart countries are probably purchasing Bitcoin covertly, avoiding public declarations that might enable rivals to anticipate their movements. Until next time, happy investing